What's going on YouTube? Welcome back to the channel. My name's Andrew Babin, and I remember 7 years ago earning my first few paychecks after college, knowing I needed to save for retirement and open up an IRA, and I had to decide between a traditional IRA and a Roth IRA. Now, knowing what I know now, looking back, I am so glad I chose to open a Roth IRA and have been able to grow that over time, and I wouldn't want you guys to have to make the same decision without seeing this video first. So today we're going to talk about what an IRA is, the difference between the two types, a traditional and a Roth, and lastly, I'm going to leave you guys with the most powerful reason why I believe the Roth is not only superior, but it is perhaps the best type of investment account that we could open up today. Now, as always, I am a certified financial planner, and I am obligated to tell you that this video is for educational purposes only. It is not financial advice by any means. And with that out of the way, let's get into it. So what is an IRA? Well, IRA stands for Individual Retirement Account, and these are certain types of accounts that the government allows us to fund that give us additional financial incentives to save for our own retirement. Now, why would they do that? Why would they offer that to us? Well, it's simple, because if we're not providing for ourselves in retirement, then who is? Probably the federal government through programs like Social Security. So they give us an additional financial incentive to save for retirement in these types of accounts called IRAs. So let's walk through some key components to these IRAs. So no matter which one you choose, number one, you have to have earned income. So salary, wages, self-employment income. The key here is that this can't be passive income or inherited money. You basically have to have a job and be paying taxes to be eligible to contribute to these accounts. There is a combined maximum contribution of up to $7,000 in 2025. Now, this number has a tendency to increase over time. When I started contributing in 2019, this was closer to the $5,000 range. So over time, it goes up, basically indexed to inflation. And if you're over the age of 50 years old, you can do an additional $1,000 catch-up contribution. But for those of us under 50, $7,000 is the maximum in 2025. Now you could split this contribution between a traditional or a Roth. As long as in combination, they don't exceed $7,000, you are good. The last component here is that these funds aren't intended to be withdrawn until the age of 59 and a half. Now, I put an asterisk there because in the Roth IRA, there is a certain benefit where you can access some of those funds before you're 59 and a half. But generally speaking, you don't want to put money in here intending to pull it out beforehand because there could be penalties and taxes that you can incur for doing that. So this is a long-term money. You want to put it there. There's a reason it's called an IRA. It's for retirement. So before we walk through the specific differences between these two types of accounts, let me summarize it for you in a few sentences. So in a traditional IRA, we are going to owe no taxes today, but in the future, when we go to retire after 59 and a half, we're going to have to pay those federal income taxes. Now, in a Roth IRA, we are going to pay taxes today, but later on down the line, when we go to retire, we will owe no federal income tax. And that is the key difference. So let's walk through the specifics and how that looks. Starting with income limits. So the traditional IRA has no income limits, meaning you can make as much money as you want and you can always contribute to a traditional IRA. In the case of the Roth IRA, there are income limitations. So if you're making less than $150,000 in modified adjusted gross income, you can fully contribute. If you're making between $150,000 and $165,000, your ability to contribute starts to be reduced. And if you're making over $165,000, you cannot contribute at all. These income limits do change if you're married filing jointly, so I'll include a link in the description so you can see those exact specifics. These figures also change every year. Again, they're indexed to inflation, so these are just as of 2025. Moving on to the tax deduction. In the case of the traditional IRA, we may be able to deduct our contribution, but that also has limitations. And those limitations are primarily around whether or not you participate in your workplace retirement plan, like a 401k. So for example, if you're single and you don't contribute to a workplace retirement plan, you can always deduct your contribution. There are no income limitations there. But if you are contributing to a workplace retirement plan, again, like a 401k, if you're making less than $79,000, you can deduct your full IRA contribution. If you're making between $79,000 and $89,000, you have a reduced deduction. And if you're making over $89,000 in modified adjusted gross income, you cannot deduct your contribution. contribution. Again, these figures change if you're married, so I'm going to include another link down in the description so you can see what that exact table looks like, but this is really important to understand. Another note on a tax deduction is I want to clear up what this means in terms of savings for you. You may think that a $7,000 tax deduction means you're going to save $7,000, but you would be wrong. What you're actually saving is the taxes, the federal income taxes you would have paid on that $7,000. So let me walk you through an example. Let's say you're earning $60,000 a year and you contribute $7,000 to a traditional IRA. That's going to put you in the 22% federal income tax bracket. So what that means is rather than being taxed on $60,000 of income, we deduct the $7,000 and we're now taxed on $53,000 of income. So what do we save? We save our federal tax rate times the amount we contributed. So if $7,000 is taxed at, for example, 22%, we would save roughly $1,540 in taxes this year through our tax refund. So you're not saving the full $7,000, you're saving the taxes you would have owed on that, and that's a big misconception, and I want to make that very clear to you guys. In the case of the Roth IRA, we don't have any tax deductions, so none of this stuff applies. No tax deduction, so slight advantage again to the traditional IRA. But this is where the advantages to the traditional IRA end. So next up, we have our tax status. So in the case of the traditional IRA, we have a tax deferred status. What tax deferred means is that you won't owe any capital gains taxes on profits you make in the account. Rather, you're deferring all of those taxes to the point at which you retire, when you would then pay taxes on those earnings. In the case of the Roth IRA, we have a tax-free status. So what do we mean? As long as you live till 59 and a half years old, you won't have to pay taxes on any of the earnings inside of this account. And this is a major benefit of the Roth IRA. So big win to the Roth IRA here. And next up, we have access to principal. So we don't get this benefit inside the traditional IRA, but inside of a Roth IRA, at any point in time, we can access our contributions completely penalty and tax free. So let's just say, for example, you contribute $7,000 to the Roth IRA for 4 years. That's $28,000 in contributions. And the account value at that time is $56,000. So what that means is your principal or your contributions are $28,000, and the investments you selected in that account have happened to double in value to $56,000. That $28,000 that you put in, because you already paid taxes on it, it's your money, so you can withdraw that anytime. If you want to start a business, buy a house, you have access to these funds. In the traditional IRA, because you didn't pay taxes on that money, you can't touch the principal. So another major win to the Roth IRA. It basically acts as a piggy bank. If you ever need that money, you can go in and grab it. Then we have RMDs at the age of 73. So what is an RMD? An RMD is a required minimum distribution from the account, and those start at age 73 on a traditional IRA. The reason you have to pull out a required minimum amount is because, again, you're deferring taxes and the government's not earning any tax revenue from you in the account if it's just sitting there. So what they do is force you to pull some of that money out. That way they could start to collect tax revenue on it. And in the case of the Roth IRA, we don't have this problem because, again, we already paid taxes. The government already earned tax revenue from us. So we don't have this restriction. We can let that money grow and compound for as long as we want. Another big win to the Roth IRA there. And lastly, we have tax to our heirs. So if we don't touch this money and we want to pass this down to our children or grandchildren, in the case of the traditional IRA, they're going to owe ordinary income taxes on that. So it's going to be another form of taxation when they inherit the money. Whereas in the Roth IRA, again, we already paid the taxes, so our heirs can inherit the money federally income tax free. They might still owe something like estate taxes on it, but for federal income tax purposes, we can pass this down to people completely tax-free. So the major theme around this is in the traditional IRA, we're deferring taxes to the future, right? We might save a small amount in taxes today, but what we're giving up in exchange is really control over that money in the long term. And you could see that play out here in these different categories. In the Roth IRA, we already went and paid taxes, so we have a lot more control and flexibility over that money as it grows throughout our life. And that brings me to my last point, my favorite feature of this Roth IRA that makes this the most powerful investment account that you could possibly open. So let's talk about that. The real reason I love the Roth IRA so much is because it represents 100% freedom and control over your money in the future. There's no other account structure out there where as long as you live past the age of 59 and a half, you own 100% of the results in that account. Now, traditional finance tells you that if you think you're going to be paying less in taxes in the future than you are today, you should use the traditional IRA. But I would ask the audience, do you really think we're going to be paying less in taxes in the future than we are today, particularly 30 years from now in my case? My retirement year is 2056. That's when I'm 59 and a half years old. And when I look at where the federal government's trending, today we've got $38 trillion in debt. We literally can't keep ourselves afloat and we have to print money. And in the future, the federal government's going to be looking for any revenue source they can to continue generating revenue to keep the government going. And guess what, guys? Those traditional IRAs are out there for the taking, right? They can take as much as they need through the form of taxation. But if you pay the taxes today, you use that Roth IRA, you're basically hitting the opt-out button, moving the other direction, and you own 100% of the results in that account. Very rarely in finance can we use the word guarantee, but the Roth IRA represents a guaranteed tax outcome of 0 in the future. That's why I love it so much. And comment down below, do you guys think we're going to be paying more or less in taxes in the future? Do you prefer a Roth or a traditional IRA? And if you like this content, subscribe, hit the like button, follow along for more, and I will see you guys